We have Bill Bynum, the president of the Hope Credit Union, Raj Date, managing partner at Fenway Summer, and Ellen Seidman, senior fellow at the Urban Institute. And as they get seated, I'm going to, we're going to start off with your reactions, but also, you can do it better than I can. If each of you could in turn, when you provide your reactions to what Rachel and Jonathan just presented us, also explain, to our audience sort of the type of work you do, how this applies to, your research, your jobs, your business, that sort of thing. So let's start with Bill.
Sure. I want to start by thanking Jonathan, Rachel, and everyone who's been involved with this project for documenting something that I think many of us who have worked in this field for years see every day. But it's important to have the data that we can use to engage policymakers, and engage banks, engage families in a more informed manner. I'm the CEO of a community development financial institution based in Jackson, Mississippi. We work in Arkansas, Louisiana, Mississippi, and Tennessee, which is arguably the most economically distressed region of the country. I've been doing this work for about 30 years, worked in North Carolina with an organization called Self-Help, did micro lending there before I moved to Mississippi. And Frank, you'll appreciate, I think you'll remember some of the analysis that we did early on. It was on a more focused group of micro entrepreneurs as a part of a self-employment learning project. And some of the findings here are consistent with what we saw in the group of micro entrepreneurs, and it really made clear that low-income people, these low-income entrepreneurs, really did quite a bit of income patching. Their incomes were inadequate to meet their families' needs, and so they relied on a lot of different sources, in many cases informal sources, because they didn't have ready access to the traditional financial systems. And we certainly see that in our experience in the Mid-South. We have the highest percentage of people in the country who are outside the banking system. I know that there's, the findings and this assessment focused on people who are banked, but it's 40% of our members in our credit union didn't have a banking relationship before they came to Hope. We have the highest concentration of subprime mortgage lenders, payday lenders in the country, so there's quite a bit of reliance on those alternative sources. And so with a credit union, we, and many community development credit unions, often serve as a proxy for those friends and family when individuals don't have families and friends that are readily available to fill in that gap that was described in the data. They need a source, and in many cases that source is a high-cost, abusive, often predatory lender. And so where we can provide an alternative, it helps to deal with some of the volatility that many of our members and many low-income residents experience. I think another important takeaway for me from this, and something that I think, again, people who work with low-income populations over a period of time recognize, is that it does a good job of, I think, breaking down some of the stereotypes of low-income people. Financial literacy is obviously important, but low-income people aren't dumb. They make very rational decisions. They have limited tools at their disposal to smooth out the volatility, but they make decisions that allow them to make it from day to day and support their families and move forward. I think the question, and I expect we'll delve into this quite a bit, is, all right, we understand this more, now what do we do with it?
Sure.
So I think that's an important conversation to have.
Exactly, great. Raj, tell us a bit about what you do and also your reactions to Jonathan and
Sure,
Rachel's,
sure.
presentation.
Well, first, thanks for asking me here today. And I'm really struck. I mean, this is a terrific piece of work, and it also feels difficult to do and like expensive. And so when those things are present, you know that probably a lot of people had a lot to do with its success to date. So thank you for that. These days, I run a hybrid advisory and venture investment firm that's based in Georgetown, focused just on consumer finance, almost all just in the U.S. And the thing that binds together all that we do at Fenway Summer is sort of this notion that you need good, clear rules of the road, and you need an industry that has got some safeguards built into it. But the main thing to drive out bad practices and bad ideas is to be sort of cheerfully ruthless about generating better ideas and driving the bad stuff out of the market. So that cheerful ruthlessness will infuse many of my comments today. My main reaction, actually, is that this kind of work really can enable some of that approach, some of the innovative approaches that can make financial outcomes and financial security better for a pretty solid part of the country. And the reason I say that, and frankly, that's sort of new news for me. Early in my career, I was at McKinsey & Company when we, at least in those days, in consumer finance particularly, we didn't do a lot of deep customer insight. Like I had a client once suggest to me, well, have you even met one of our customers? Why don't you go sit down? And I said, but why? That sounds horrible. I don't want to do that. That sounds awkward. And no. But as it turns out, you learn stuff. And some of the things that you learn help in, I think, three very important ways. So very important way, number one, it allows you to be concrete about the actual problem you're trying to solve. We're building a credit card business today at Fenway Summer, and the reason why it is going to succeed is that we're being very concrete about the kind of customer and the kind of need that we're trying to satisfy. In other words, we're going after this unmet need of mismatch of income and expenses. We're not pretending that everybody who's in a payday loan today is there because they have an unforeseen expense. My car broke down. That's true for some people, but it isn't true for most. And as it turns out, a hyper-expensive closed-end loan is a bad way of satisfying a recurring income and expense problem. And this kind of work allows us to be very concrete about that specific need, design a product and a pricing strategy that actually does it better. The second aspiration, I guess, I have for this kind of work as it moves forward is that it will help us as an industry translate data, which has never been more available, into insight. So I'll give you a couple of examples of where that's been lacking in the past. So both of them from the credit card business say. I know a lot of people in the credit card industry. And by and large, every single mid-level executive in credit card land knows this dynamic of why it is you can't have as big of credit lines on a credit card vehicle as you would extend through an installment loan to the same person. And the reason is just sort of arithmetic, right? Like if I give everyone a $1,000 line, the people who don't pay back typically borrow the whole $1,000. So you have this kind of disproportionate, the dollars get disproportionately lended to the people with the least probability of paying you back, which is a tough way to run a railroad. But there's a second thing at work as well, which is the so-called second order problem. And it's not just true for low-income people, it's true for everybody. If you give me a $100,000 line, I'm probably going to be okay. If you give me a $10 million line, I'm going to blow myself up. I will buy a boat and, that's it. And that second order problem actually, analytically, is very tough to get to the root of just by looking at the numbers. At some level, you have to have a better insight of people's actual psychology. Different example. This notion that when you look at subprime credit performance during the recession, it was disproportionately good. People actually fared better than their prime counterparts. Like why? At some level, it's because for low-income people in the United States, it's always kind of a recession, right? They already have generated ways to cope with very difficult circumstances. But analytically, divining that from the numbers is pretty tough to do. You actually have to understand kind of needs on the ground. So translating data into insight. And then the third thing that I'm very hopeful about is the ability to better align how it is that people have already engineered and shaped their financial lives in a way that makes it easy to get them to adopt better products at better prices. So when I think about some of the frustration in the industry broadly. So for example, finding someone, getting someone to call you on the phone as they become late on a payment is terrific. Like if you can just talk to them, in general, that person's gonna end up way better off, but people tend not to call. And to lots of people in the credit business, like that's upsetting, it's so frustrating. Why don't they just call me? Well, actually, you sit down and you realize that, because people already know that they're in a jam. They don't need you to tell them about it. They find it humiliating, it's terrible. But actually sort of appreciating people for the fact that, number one, they're not dumb, and number two, they know their problems more than you do, I think might be able to create some hooks to be able to actually speak to people in a way that aligns with their actual lives. I could go on forever, but I will not do that.
So I'm Ellen Seidman, and to me, this is the culmination of something that started with a trip to South Africa in January of 2008. And I'm enormously grateful both to the Ford Foundation for having sent us to South Africa, and then to Ford and Citi and Amit Yaram and the whole team, NYU and CFSI, for following through and doing this. It's an incredibly important study, and it is important. It started out sort of thinking about financial inclusion and financial services. I think what we're really understanding is that it has all kinds of tentacles and all kinds of implications. And I really do wish we could go back out in the field and do this again after the ACA, because I looked at the data that's on your thumb drive that you got, and 60% of the households have at least one chronic health condition, and almost 70% of the households deal with the stresses by fooling around with their meds to the point where they're not doing what they should be doing. And so it just really highlights how incredibly broad and important this is, well beyond financial services. I will say that, so I'm more of a policy wonk. I work at the Urban Institute, and I'm on the Consumer Advisory Board of the CFPB, which Bill chairs. And I'm a Washington person. And so I think about this in terms of policy, and I think we'll get to that. But I will say the things that struck me about the study, and I've been sort of following it as it's been coming out, is first of all the volatility issue. It's huge, and it has enormous policy implications. I actually, though, really do want to say that I think that everybody in this room probably is sitting there thinking, well, hell, I got volatility in my monthly income. Yes, you do. But you're above a level where that volatility is fragile to your family's health, financial health, and frankly, physical health. And it's this volatility that dips into potential tragedy that is really the story of the diaries, in my opinion, and this inability to create the cushion that gets you beyond soon into later. The second thing is the communal money piece of this. One story that they didn't tell is about one of the Mississippi families who, gosh, you look at them and you say, how can you, I mean, why are you people giving $50 a week to the church? You barely have enough to eat. And the answer was, the church will be there for me when I don't have enough to eat. So communal means a lot and is a really important concept, and it's one that our policies that are aimed at individuals and at nuclear families just do not get to. I think the savings thing that, particularly the informal savings and the savings circles and how to make those more effective and regard them as a real asset to this country, as well as to the individual families, is another really important part of this work. I will say two things that I think we need to be careful about. The first thing is I actually disagree with Rachel and Jonathan that this is something that can be, this instability is something that can be solved by financial instruments. I think financial instruments and the kind of thing that Raj is working on, the kind of work that Bill does, and all of the equivalent organizations across the country are really, really important. But if the incomes are not up to a certain level, we're not gonna do it. And it's not just incomes; it is also job quality. And we can talk about that later. And the second thing is, I think you've got to be aware that this is a one-year study. And while Rachel says you can do it in less than a year, in many ways, it's also important to think about more than a year. Because some of the families that look like they're going to make it fall off a cliff. Some of the families that are precarious, as Rachel discussed, do make it. And then the other thing that they couldn't see because it's only a year is that it turns out that intergenerational transfers actually make a difference, but even for families in this modest income group, and in fact can sometimes make a very big difference. A sudden $25,000 inheritance can make a very big difference to a family whose entire annual income is $25,000. So, you know, there are pieces here that we need to study further, but my God, this is such an unbelievable advance in what we know.
Yeah, well, Ellen, you've sort of perfectly anticipated the first question I had, which is a bit more aimed at Raj and Bill, but I'm sure you will have response as well. But it's this question of, to what degree do financial instruments, can a credit union, can investing in these sorts of consumer finance businesses, to what degree have you seen it help people out of this sort of instability? And to what degree do you think it can or can't? Is there a limit on that? I'm not sure which of you would like to start here. Let's go with Bill.
No, sure, I'll jump in. I'm obviously biased.
Sure, of course.
You know, we, again, are working in a region where a high percentage of the population is unbanked. And, but I do want to echo Ellen's point that financial solutions by themselves are inadequate. We really need comprehensive approaches to the needs of families who are living on the economic edge. And as we know, more and more people are on that edge. I think I've gotten more mileage out of Standard & Poor's analysis, the study that says that the widening gaps are really threatening the economy's ability to rebound. And you know, we've engaged the Federal Reserve Bank of Atlanta in discussions around this, trying to get them to engage with banks to be more focused on this issue. The president of the Atlanta Fed met with a group of policymakers and bankers in Jackson a while back and said that the exclusion of large segments of the population from the banking system really limits his ability to use monetary policy to influence the economy. And so, so we need people to have career pathways. So we need people to be able to generate adequate income to support their families. And as Ellen said, we all have spikes. Many of us, you know, those spikes are dividend payments or bonuses. For a low-income family, it's EITC, and and the spikes it smooths out their lives for a bit of time, but by and large, they just don't have adequate income to make ends meet. And for those who are caught in a position where they have to rely on alternative high-cost financial providers, it helps them in the short term, but it inevitably puts them in a situation where they get they're paying more for that debt, and they get caught into a debt trap that is harder for them to get out. And when they don't have traditional financial institutions to help them out of that situation, then it's going to really put them in a much deeper hole. We have seen many circumstances like the ones that were described in the diaries. Some of the stories come from East Mississippi, where a few years ago we were able to, it's in 2008, 2009, and as the recession was causing many financial institutions to experience problems in Eastern Mississippi, the economy is very reliant on the timber industry as the housing industry declined. People were losing jobs and couldn't make their loan payments, and this credit union experienced problems, and we were able to merge it into our credit union. And many of the borrowers, many of the members just did not have income to make the payments.
Right.
And so we were able to restructure some of them, but for many people it was an economic reality that credit alone could not address. But in some cases we've been able to consolidate, in many cases we've been able to consolidate short-term loans and help people recover, lower their payments by $200, $300, which for a low-income family is a great deal of money. And so I would say the solutions beyond what we don't deal with, education, adequate cost, affordable health care, increasing wages,
Sure.
which is very important. What we can do as a financial institution is make responsible, affordable financial tools available to low-income people. We see that even with kids, we've done several hundred child savings accounts throughout our region, and data shows that when someone has $500 in savings, by the time they go to college, they're more. By the time they reach age 18, they're 3 times more likely to go to college and 4 times more likely to graduate, which puts them on a path toward a more stable financial future. But in the absence of a vehicle to save, then they don't have that opportunity.
Is that necessarily causal, though? I save and then I go to college, or is the type of person who's likely to save the type of person who's likely to go to college anyway?
I think that's a fair question, but I think the fact is it puts them in, I think the structure, the thinking about your future,
Sure.
just that mindset. So many people, again, who don't have a relationship with a financial institution, they don't have a mindset of planning for the future. So I think the mindset of saving, of thinking forward, is a big part of that.
Sure. That's a great point. Raj, I'm curious about your perspective on this as well.
Yeah, well, I mean, first consider the source, right? I have either spent or wasted my entire career in consumer finance. So what am I gonna say?
Lots of bias.
But I think it's. I would acknowledge. I mean, my main economic insight comes from Chris Rock, right? Who recently said, if poor people knew how rich people were, there'd be rioting in the streets. So I do think long-term inequality is a real threat to
Right.
democracy. I'm not authority on any of these things, but I will, as it relates to consumer finance and its impact on if there's an ambient state of economic stress, it is inconceivable to me that consumer finance as it's structured today is merely neutral to that level of stress. And in fact, what we see is that for most people, consumer finance makes lives better, and for a distressingly large number of people, it actually makes lives worse. And some of that is just structurally dumb. Right, so for a big chunk of consumers in low-income parts of the population, effectively they borrow in 2 big ways. One, they borrow at 0% from friends and family,
Right.
who by and large, by the way, are the least well-equipped to lend money, right? Because their lives are almost as precarious. Or they borrow at like 300%, effectively, using repeated overdrafts and the like. That's just dumb. Like that is not the sign of a healthy market structure, and I'm glad that there are firms, including some that we're backing, that are going to stop that.
Gotcha. And Ellen, I'm curious about your take on.
Well, so I got into learning about and thinking about what was then called the underbanked, or the unbanked, sorry, when I ran the Office for Supervision. And when it became painfully apparent, because I was and am a very big fan of the Community Reinvestment Act, that the thrifts that had in the 30s, 40s, 50s, 60s been the local community institution for working class families to save and to build, to get a mortgage and to really stabilize their lives, they weren't doing it anymore for a whole host of reasons. I mean, some were, but a lot of them weren't. And that something needed to be done here. And then the Treasury Department was asked, which OTS was part of, was asked to convert all benefits to electronic deposit, to direct deposit, at which point they actually did a study and discovered just how many of the recipients of those benefits didn't have a bank account. And so the whole question of whether the financial services system was adequately serving a very large portion of the population, became something that I became extremely concerned about, and ultimately managed to hook up with Jennifer Tescher and work with CFSI. So my reaction to what Bill and Raj have said, and particularly what Bill has said, is if we had 1,000, 1 million, or 1,000, 10,000 would probably do it, builds and Hope credit unions around this country, we would be in a very different position. And the question is not, can traditional financial institutions make life better and create less volatility for the lower income part of this population? It's will they? And the tools that we have used so far have not been terribly effective. There are community development banks, community development credit unions, there are some community banks, some mid-regional banks, some bigger banks even, that do a pretty good job, and some credit unions of all sizes that do a pretty good job. But the fact of the matter is, universally, the kind of desire to work with this population, and therefore really doing what Raj said, finding out what they want, finding out how to make their lives better, just isn't happening. And I really think that we need to be spending much more effort figuring out how to change that. And the traditional answers, like everybody has to have a Lifeline checking account, and frankly, the Community Reinvestment Act, as it is currently implemented, are not working.
Mm-hmm. Go ahead.
No, I think that's right. I think there are, I love what I do. I know what I do is woefully inadequate in terms of scale and scope, and other community development financial institutions across the country who focus on this population do a great job, but we are a drop in the ocean relative to the need. But I think there needs to be policy that focuses on both increasing access to responsible and affordable financial services. We all rely on access to financial services to help us level out the volatility in our own financial lives. Mm-hmm. Low-income people and disproportionately communities of color don't have access to those tools, and that's wrong. And we're shooting ourselves in the foot as a country as we become more and more diverse, and more people are on the outside looking in. We're going to ultimately pay the cost of that if we don't address it. And so, Community Reinvestment Act is outdated. It was created at a time when organized around branch banking, and Banks have closed in record numbers since the recession. 93% of those have been, according to Bloomberg, were in low-income census tracts. So more and more people who did not have adequate access to financial services to begin with have even less access to financial services. And so looking at how we hold banks accountable to providing financial services, affordable financial services in those communities where they generate profits. And they generate profits in the Mississippi Delta by mortgages that they purchase, by credit card, by other financial tools that they generate fee income off of. And so they're getting income from those communities, but they don't have a branch there, so they're not held accountable for reinvesting in those communities. So the Community Reinvestment Act and modernizing that is critically important. And the other policy focus, all of us are, I'm more wearing my community development finance hat today, but we all are tied to the Consumer Financial Protection Bureau. I think that, along with the Affordable Care Act, in my opinion, are two of the most significant actions to come out of this town in generations because of the sheer number of people that they touch, the financial abuses that are put upon people in low-income and rural communities is just outstanding. I wish I could get everyone in this room and drive through the Mississippi Delta and see how many towns don't have a traditional financial institution, but there's petty lender, check casher, pawn shop lining the streets, and those are what people rely on. So again, I understand that many of these folks are banked in the study, but so many are not banked, and so as a result, they're paying more. You know, gas costs more when you're poor. Health, you go without insurance, health insurance, so your health care costs more. You don't put away money to save for your kids' education. So having to pay more for responsible, affordable financial services, or not having access to affordable financial services and having to pay more for short-term loans is detrimental to the economy and to these families.
Gotcha. And so, okay, so we're going to bring Rachel and Jonathan back up here. I think it's about time for that. And hopefully you all we'll have a discussion about their findings as well.
Danielle, I have a first question that
Sure.
came in after we collected cards, so I'll kick us off this way, and then we have microphones to move through the audience. So Danielle, we'll call on you, and we'll get a microphone to you to ask a question of it.
Okay.
The question is, did you find that people got loans for things they couldn't really afford because they wanted to feel middle class? Or how much of there was this incentive to consume beyond means versus I didn't know I couldn't afford it because I didn't know what my income was going to be?
I think that's really hard to answer. I mean, we knew from the beginning that, you know, there's always a question when you're looking at the financial picture of really anybody else, right? Like it instills some judgment. Like you immediately think, I don't know that they really needed that. You know, and certainly we see lots of spending in the sample that you immediately think, oh, well, if everybody quit smoking, there's some financial capacity right there. You know, that would be better. And so we tried really hard not to engage in that way of doing the analysis. People are for the most part, are buying what they think they need. We didn't see, you know, profligate spending or real awareness necessarily about overspending. What you see is intentional splurges, right? And so, for example, one household is really disciplined about cordoning off money and saving, and to the extent that their extended family thinks of them as sort of dismissing their culture because she's being so disciplined. And yet, the part of how she enables herself to do that, this particular head of household, is that she cordons off a separate bucket of money that's for splurging. And that's a really constructive behavior, right? I'm going to eat really carefully all during the week, and on Saturday I eat dessert. That works for people.
Okay. Let's take some questions then. If you have a question, raise your hand. It looks like we have someone already who is lined up.
Clearly the money's out there, and we all agree that more income in these families would help. is there any long-term strategic goals to begin to package this for lawmakers in language they can understand, with all due respect? To make laws that make to create more fair market laws that force more of the income to the people who actually earn it and generate it for our country.
Yeah, I think we're all looking around, hoping many people have opinions. I think that part of the power of a room like this is that hopefully many of those in this room who work on policy will take up that banner. I think that the problems in our society around income inequality are pretty significant, and the need that we may have for government action around being really creative about new forms of establishing resilience and greater control is substantial. I don't know that, I'm hoping additional people have opinions about how government could do that. And in DC, most conversations end up heading towards the fact that right now we don't really have political will to think about it in that way.
I mean, I think, sorry.
Yeah.
I mean, there are two questions about the government, and one is, we sit in DC and we think about federal government. There are a lot of other governments that are involved, a lot of local governments, city governments, that have more flexibility to address these issues locally. But I was joining Rachel, Raj, you've done a lot of the thinking around the CFPB and the political environment that made that happen. And Ellen, too, you've been involved in a lot of this. And I am curious your views, whether this is politically the right moment or the wrong moment to be putting these ideas on the table, and whether these issues are harder or easier than some of the other things that are also on the agenda.
So I think one of the things that's important to recognize is that particularly big policy takes a very long time to make. And so having this work and continuing to explore these issues is a necessary start. And as I mentioned earlier in my remarks, and as they've mentioned, this started about financial inclusion. I believe the conversation has gotten much bigger and aims for much bigger policy implications. Now, there are the income-based policy implications, the minimum wage being the most obvious of those. There are the sort of safety net policy implications, the ACA, and what we do about the fact that we have, over the course of the last 30 years, taken both retirement security and education and turned it from something that is where the volatility is on either the citizenry as a whole or employers, and pushed it on to individuals and families. And it obviously is the most difficult for families who can afford it the least. And then there are some interesting other kinds of policies, some of which are smaller, some of which seem unrelated, that may also be useful. The Center for American Progress, for example, has a proposal out there to allow people to take down $500 of their earned income tax credit in advance. The advanced EITC eventually was done away with because as it was originally structured, it didn't work very well. The lump sum was what people really wanted. But the ability to take a small amount that can get you over a dip may be a really interesting policy, and it won't cost anybody anything. I was impressed, in part because I am a transportation geek sometimes, about the difference in the urban and rural parts of the interview group in terms of transportation expenses. And while the urban side was lower, first, that says a couple of things. First of all, it says to me that gasoline prices are an incredibly important part of thinking about the financial stability of this group of households. Everybody think about gasoline prices in the context of financial inclusion? Come on, we don't. We need to. But it also says that better transit is a really important part of thinking about how this group of folks, and in fact all of us, can lead more effective lives. So I think that this is an incredibly important beginning, and I love the fact that they've come to Washington to open the conversation, because while I totally agree with Jonathan that some of the most interesting and exciting stuff will happen at the state and local level, at least for the next couple of years, ultimately, Washington is going to have to face this set of issues and make some major changes.
I'd just like to say, you asked the question, is this the right time? Is this, I think this is a necessary time. I do, and I think the circumstances, again, the discussion around income inequality, the recognition that it is not just a challenge that is damaging low-income communities, but it's detrimental to the overall economy. I think there's more recognition of that than there's been in a long time. Channeling my friend Chris Rock here, I think there's an urgency as well about focusing on this. There's a relationship between what's happening in these communities, the income disparities, the volatility, and what happened in Ferguson and in potential Fergusons around the country. I think that we ignore this at our own peril. I think there are solutions. There are comprehensive solutions. I think you can be certain that, I'm glad to see folks from the CFPB here today that are, I know you've been in conversation with the CFPB, so paying close attention to these findings, and Ellen and I will certainly make sure that our colleagues on the advisory board, we share it with them. And so this will, the CFPB will certainly take this, and to the extent that they can, present, I'm sure, Congress and the administration with some past solutions to go forward. Whether or not we act on that is the big question in this town. But I think there are also solutions in, that the financial institutions and people outside the policy, the federal policy system can take advantage of. So I think the insights are important, and the urgency is there, and I think there are enough people focused on these issues that the time is right.
I'll just add, if it were me, which it is not, I personally would be focused on the one area I think that is going to drive the best long-term economic mobility in the country, which is manifestly broken today, and that's education finance. Obviously doesn't work arithmetically. So there's a pretty decent argument I think you could make that we could view this as a people better for less money. So it just given sort of my understanding of the political climate, I would put most of my chips on that one.
I want to follow on and jump in with a question here, which is, Raj and Bill, you've both spoken to this sort of gap in the market in some places between, the payday lender and, that with a bajillion % interest, and me borrowing from my sister at 0% interest. Clearly that hole hasn't been filled, and, as Ellen said, we need, 10,000 more bills. So what do we need to make that happen?
So I'm going to suggest something that, I grew up in banks, right? So I also am infected with parochialism, that invented the word unbanked and underbanked. I got news. Nobody walks around in life saying, you know what I need? My life would just be a little bit better if I had just a little bit more bank. That's, bankers say that. Nobody else says that.
Right.
And so I just want to suggest the slightly scandalous notion that the answer to this long term is not going to come from insured depositories.
Sure.
And the reason for that is the sine qua non of an insured depository is privileged access to leverage. Right? If you and I want to start a little business, we can't day one borrow $9 out of every 10 that we need. Mm-hmm. Banks can do that, and there's a reason why they exist. But that reason has almost nothing to do with the needs of this population.
Right.
Privileged access to leverage doesn't matter for these needs. What you need instead is effective credit intermediation. You have to have efficient payment systems, and you have to be willing to sit down with people who don't actually have any money, so they are not going to drive the bottom line
Right.
in terms of deposit volumes, and figure out what they actually need. You see, it's not just consumers. You see the same thing in small business. Right? Small business finance is like a disaster. And small businesses, by and large, have the same kind of kind of juggling, kind of like cash to try and make ends meet. And there's a reason why, as a sector, we're so bad at it. Small businesses don't have a ton of money, right? So, where are you going to put your best people in a big bank? Like, realistically, I personally don't see it. Like, I wouldn't bet on the insured depository sector being the long-term answer to these needs.
I see. Gotcha.
But that's just me.
Ellen or Bill, do you have a take on this?
I wish the insured depository sector, particularly, frankly, the credit union sector, could be the answer for a number of reasons. I think there is the advantage of the safety of the deposits. There is the advantage of the fact that there are, in fact, 12,000 credit unions, 7,000 banks. There is the regulatory oversight. My concern is, in many ways, that we've been trying that a lot, and it has been an insufficient solution. And I think we need a combination of things. I think that one of the things that has happened really since 2008 more than before is the community development financial institution sector has really come into its own. And people understand that it's there. And the credit union side of it in particular is focused on consumer lending. There are ways of increasing the number and reach of that sector in a fairly inexpensive way. Frankly, more money to the CDFI fund pushed through to that part of the sector that, by sector I'm actually saying both the CDFI sector and the depository sector that serves consumers well, it's leverage at the institutional level that then helps low-income folks at the individual level, even though I agree with you that the low-income folks at the individual level neither need nor provide leverage. So I think that we've got to do both. Because I also think that, particularly outside the pure credit sphere, there are definitely roles for innovation by non-depositories. And then, I'm not betting on Raj with money because he won't let me. But I'm betting on Raj in a lot of other ways.
This is not a general solicitation for funds. Securities laws purposes.
Securities laws, right, yes, exactly. But I'm betting on him in other ways because if he can, in fact, figure out on the credit side how to do some of this and do it well for both the provider and the user, maybe he will lead the way, and we will have a broader range of alternatives. It's not neither or.
Yeah, I would add to that I think we're talking about this as though it's only a low-income problem, and it is much more challenging for those at the low income, and that does make the business model harder for everyone. But the reality of what we're seeing is that this is a middle class issue increasingly as well, and that the problems that we've been associated with poverty are really endemic to our current economic era and the structure of work for many, many people. So I think we need to think about what the positive there is too, right? The negative that we've been showing is that the nature of work has changed in a way that leads to a lot of instability. The upside is that the nature of work is changing because technology is being infused throughout our economy in ways that I will sound trite in explaining, right? We all are seeing it and experiencing it. And so I do think technology, the use of data, is going to enable us to come up with some new business models that I can't even fully imagine that are streamlined, that enable us to figure out which subprime payers are going to be, borrowers are going to be likely to repay and which aren't, right? Who's insolvent versus who's illiquid, which I think is a core issue. Right? All these issues I'm talking about in terms of budgeting, that it looks impossible to me to expect people to budget, we should be able to solve that with data, right? Not today, but we should be able to get there, where you're tracking as a business somebody's cash flows and able to provide them real-time advice or real-time bill payment help. We're going to get there, right? That's the upside of the change that we're experiencing as a society.
The notion of 10,000 bills scares me. But the idea of a network of financial institutions that are providing affordable, responsible financial services in communities that are experiencing an exodus of depositories, I think is critical. We cannot let these communities continue to turn into bank deserts, and that's happening across the country, particularly in rural and minority neighborhoods. And so addressing that is critical. I think, CDFIs, credit unions, often a proxy for families who don't have friends and those other informal networks who can step in and fill those gaps. I think that's critical, and putting the brakes on the abusive practices that are that rush in when banks rush out.
Sure. So there just aren't the incentives there for those banks to stay in the communities then, right?
There again, the policy, the Community Reinvestment Act is broken. It was intended to facilitate access to financial services in these communities. Is antiquated. It needs to be updated. And there are, interestingly, Mississippi has the 4th highest number of community development financial institutions in the country. Many of them were able to take advantage of resources that were made available after the financial crisis and access TARP money and became CDFIs. They're supposed to direct 60% of their financial services into these high-risk communities. They're not doing that at the level, and there's not the accountability structures and not the enforcement to hold their feet to the fire. And so there are structures that would facilitate it if they were if there was accountability and if, again, some of the policies, most notably CRA, was updated and to accommodate the realities of today's financial system.
Gotcha. All right. I know we have a lot of other questions. Yes. Sorry, woman in the red, right here.
Thank you. You touched on my question, hello everyone, a little bit in the last segment about technology and innovation. We've entered a period where the traditional financial industry is facing very transformational, disruptive change, and technology, both through data, as you said, Rachel, and through payments innovation and people being able to use their mobile phone for financial services, is creating both opportunity and risk. And we've got behavioral economics coming in on top of this and creating this very sophisticated ability to either help people make better decisions or manipulate them into making worse decisions. So would any of you speak to either the findings of the research that may help us think how policymakers should think about these changes, both the opportunity and risk of the innovation that's underway, and sort of prepare the policy framework to optimize that instead of let it be a negative?
So Joanne, I thought you were going to ask us the mobile banking question. So I'll answer the mobile banking question, which is, in essence, do we really need all those branches? I do think that while we're modernizing CRA and thinking about how people actually operate these days, we need to figure out how to take advantage of the access to quality financial, both services and institutions, that mobile can provide even without the physical presence, without giving up the portion of the physical presence that that makes people feel comfortable using those channels. So I don't know what Bill actually thinks about this, although I think I've heard him talk on this subject. But, in my mind, having a really good 24/7 video kiosk connected to bankers who can communicate well in a variety of languages is a hell of a lot better than no bank, or no branch. And so I think we need to make use of it. I think the technology, the policy technology stuff is in many ways, a lot of it is getting out of the way and letting things develop. If I were going to sort of, write down my list of policies that I think this work leads me to, maybe it's just because I'm over 60, the technology pieces are not the first ones that I'd go to.
I think they probably would be the first places I go. I mean, and I just say that. And I say that for a couple of reasons. Like the basic economic model of the traditional financial institutions in the United States, and I would argue this is also true in Europe, has not changed basically during the entirety of my career. In other words, it used to cost, depending on how honest you are about sort of indirect expenses, it used to cost like $200 to $300 a year to deliver a core DDA to a customer. It still costs basically $200 to $300 a year across the sector if you kind of load in distribution expense. You can't, that doesn't work when you're competing against people who can sell you basic DDA functionality off a JHook in a store you're already in for like $5, right? So I think that distribution through mobile and otherwise is like that's coming, and so best to just sort of embrace like how to make it best. I think that there's important policy questions around the use of broader data sets in underwriting, right? Like my favorite example, right, is two people, one pays at the pump, one pays in the store for gas. Which one do you lend money to? Always lend to the guy who pays at the pump, because the person who's going inside disproportionately smokes. Now, if you told people you were doing that, my sense is they would become upset. But it is a real policy question, right? So I think those questions are real. And then finally, frankly, we haven't talked much about payments, but we're backing a company that, using the Bitcoin protocol, can make dollar to euro commercial payments for free. Go to a local community bank and try to arrange a wire to a German manufacturer based on a current invoice. It's not easy. And so that's a real game changer as well. So I think there are pockets where getting out ahead is imperative for the regulatory apparatus, because it's going to happen one way or another.
Mm-hmm.
Technology is critical. It is, I cannot go into these communities the banks are abandoning without paying attention to the cost of bricks and mortar and personnel. So technology is a really important way to try to make that more affordable. But what it doesn't do is give people the ability to have a conversation with someone to help navigate their financial challenges.
Sure.
And again, all of us, I can call Raj and say, Raj, how do I figure this financial challenge out? But, and I'd probably get pretty good advice, but most low-income people don't have that resource. And so going to a bank and being able to talk with a financial counselor is important. So doing that through kiosks, video kiosks, through call centers, through other means is important. And more our staff are focused on being that financial problem solver, not focused on cashing checks and taking deposits. Mm-hmm. We all know, probably have personal bankers who play that role for us, but the average person hasn't been into a bank branch in 6 months.
Right.
A larger percentage of low-income people of color, have smartphones. Too many of them are unbanked and outside the financial system, but it presents an opportunity to engage people in a more sustainable way, and so I think that's a big part of the solution.
I see. So is there a bit of a behavioral hump people have to get over, where I go talk about my loan, like it feels more natural or official or something to go talk to a banker about my loan as opposed to doing it over.
I think that barrier is lessening. People are becoming more comfortable. You know, you see it on TV. You know that technology is here and that's safe, and more people are relying on it. So we're finding the acceptance of mobile technology more increasing over time. Over half of our members are in low-income census tracts where they don't have a bank branch, and so they're using the mobile bank to access their deposits. But they also have the ability to call the dial 800 number and get technical assistance on that, and also to get connected with a mortgage lender or another financial advisor.
Think about student loan servicing, right? Like the federal government has these gigantically generous kind of repayment options available. You know what the main problem is? Kids don't answer their phones, right? Like, hello, it's Sally Mae calling. Like, no, who? They don't answer the phone. So they want to interact in ways that 10 years ago would have been science fiction. And so either we acknowledge that to try to engage with our customers, or we just kind of hope that somehow technology is cyclical and beepers will come back. Like, I don't know exactly what we hope, but it's not gonna happen.
Rachel?
Well, I would add on to that. I'm going to mangle the statistics, but I saw a report recently that an extraordinary percentage of people, particularly younger people, would be just as happy to bank with Apple or Google as with Chase or Citi, right? So
goodness.
The issue is, where are people going to be? Where is the trust? So if the way to give people good financial advice is going to be to gather big amounts of their data in a granular way and isolate an individual and say, you, Rachel, you need to do this. Well, who do I trust to tell me that, right? And our corporate trust at the moment doesn't always lie in our financial institutions, and we're seeing other organizations fill that void. One of the reasons credit unions are successful is they tend to have that trust, and they get that trust in a very high-touch way. So can you develop that high-touch but also high-tech and therefore lower-cost trusting relationship?
Okay, let's get another question. There's a fellow in the back with glasses.
Thank you so much. I'm so glad I didn't have LASIK. I'm Justin King with the New America Foundation. Thanks to everyone. This is really an incredible resource, and I think we're seeing the tip of the iceberg, which is very, very promising for those of us in the field. I want to sort of turn back a little bit to the policy side. Rachel and Jonathan, you talked a lot about the EITC today. I think that's really important. It's obviously a huge part of the financial lives of ordinary families. I'm wondering if you have highlight thoughts about the rest of the suite of public assistance programs that are out there and how those show up in the diaries.
One of the disadvantages of having a relatively small sample is we don't see the broad swath of government benefit programs. But food stamps are clearly a very, very important part of the equation for a lot of the households we see below the poverty line and above the poverty line. One of the issues that becomes clear as we follow the ups and downs of people's lives is that there's a lot of stress and difficulty with the requalification, right? And if you're requalifying at a moment when you're in a spike, when you're in an upswing, you may not requalify if that's the moment. Or by the other side, if you're in a downswing, but you're not usually that, you may qualify, but really that may not be the right allocation of resources. So one of the things that's interesting is that it's a very effective program for lots of our families and really matters a lot, but it's not really built for this moment. It's not really built for this era. It's not really built for these kinds of jobs and instabilities.
And can I just add on that one? I think the income qualification spiking is a really important piece of some of our benefit programs. The other piece is the asset limit piece, which discourages savings, particularly savings beyond the soon.
Okay. I really hate to do this, but we are going to have to call it quits a couple minutes early. But you get a room full of smart people and everybody has a question. So I encourage you all to, hunt each other down afterwards and ask more things of each other. And yeah, let's thank everybody for coming out today.
It's almost afternoon, so I think I can say early good afternoon, everyone. I'm Jennifer Tescher. I'm the president and CEO of the Center for Financial Services Innovation. I also want to say a big thank you to our moderator, Danielle Kurtzleben, whose name we've been butchering all day long. I think I'm doing it every time. So let's give a hand to Danielle as well. So when the Diaries project was just a twinkle in the eye of Frank and Brandy at Ford and City, one of the things that they were extremely passionate about was the idea that this project, if completed, have significant academic rigor and really be seen as extremely credible, particularly in a town like Washington. And it's one of the many reasons why they turned to Jonathan Morduch in thinking about this work. And it was really Jonathan who thought to call me and ask if we would be willing to partner on this work, both to bring a US context, because a lot of Jonathan's previous work had been overseas, and to bring our practical understanding of how the financial services world works, particularly for low and moderate income people. So I'm extremely appreciative for Jonathan for having sought us out, and I am thrilled with the depth of this partnership. I think it has been extremely fulfilling for all of us, and now hopefully for the field. The other thing that the funders have been equally adamant about is that this work not just live on a dusty bookshelf and not just even inspire great discussion, but it actually inspire action, both in policy and in practice. And that's why all of you are here. Stories are powerful. It's one of the reasons, I think, why this data, every time we present it, talk about it, share the stories of these families, receives such an, people are so taken with it. They constantly want to hear and learn more. But I believe that it is all of our responsibilities, now that we have heard these stories, that we have had the privilege of being in people's living rooms, so to speak, that we actually do something with this information. And that it influenced the way in which we do what we do every day, whether that's on the ground, working directly with consumers, whether it's making policy, whether it's creating products and services in the private sector. So I would really encourage you to look at the thumb drive that you received today. It is actually not just the slides you saw today. It is a whole raft of other data that there was not time to present today. So significant amount of additional data for you to review. These slides will ultimately be made available on the Diaries website. I'd really encourage you to go to the website and sign up for regular updates so you know when this is posted. There will be other research posted. I understand there was also a New York Times article that was just posted a couple of hours ago that details some of the findings. So lots more to learn and study and do following today's conversation. So again, thank you so much for joining us today and looking forward to continuing the dialogue.
Thank you.